Hey, how's it going, guys? Let me ask you a question. There are two companies for you to invest. Company A grows 50% every year but makes zero profits, or even sometimes they lose 10% of their investors' money year over year. On the other hand, the company B grows 20% every year and consistently generate 10% of the pure profits out of their revenues. So which company would you invest? Most of the investors would put their money on company B because giving your money to the company that is losing money every year is just a psychologically extremely challenging thing to do. But the truth is, if you invest in company B only because the company A doesn't make any profits, then you're missing out probably the best investment of your lifetime. Over the past 10 years, the majority of the best investment you could possibly make were all the companies that didn't generate any profits at early stage. And that early stage is exactly the best time to invest for the maximum returns. Yes, I understand those early stage high-flying companies with negative earnings have much higher risk compared with the traditional blue chips. Then how to pick the right stocks becomes the key question. Is there any easy technique that we can use to instantly identify those potential high-quality companies that can give us the next 10x returns? And that is why in this video, I will share with you guys one extremely easy to use but also extremely powerful formula that can help you pick the right stocks at the early stage when they don't have any positive earnings. If you do not want to miss out the next Tesla or Amazon, then this video is exactly made for you. So please make sure you watch the video to the end and do not miss out anything. I promise you I'll make it quick and don't waste your time. Alright, let's get started. These are some of the best performing companies over the last 2 decades. What do they have in common? During the first 3 years after the official IPO, none of these companies were able to generate any positive earnings. In other words, they are burning investors' money away every single year. Fast forward to today in 2021, every single one of these companies have achieved at least 1,000% return, or what we call the 10 baggers. If we added up all these companies' total market caps together, that is almost half of the entire S&P 500 index. Half of the top 500 companies in the entire US stock market couldn't make any money in the first 3 years after they went public. If you ignore these companies at the early stage only because they had negative earnings, you would miss out the largest driver of the entire US stock market over the past 2 decades. So learning how to pick the best potential winning companies at the early stage when they had no profits and nobody there to touch is extremely crucial to your long-term success as an investor. Especially in our current macro environment, zero interest rate, low treasury yield, plus the unlimited money supply, raising capital as a negative earning company has never been easier and cheaper than ever before. Yes, I agree, investing in those companies with negative earnings at the early stage is risky. And that is why we need to learn how to separate those potential winning companies from the losers. But before we learn how to identify the potential 10 baggers, we need to understand one important investing myth: why negative earnings are actually good for high growth companies. You should always remember this. A company with negative earnings does not make this company a bad company. There are two reasons for this. Reason number one, at an early stage, a company's top priority is to grow as fast as they can so that they can capture a bigger market share and acquire as many users or customers as possible at the fastest possible pace before their competitors do. In fact, especially in the high-flying technology sector, this is their only way to survive over the long term because this thing called the network effect. Their priority is never ever stacking as much profits as possible. In the world of VC investing, there's a very famous rule called the rule of T2D3. Basically, it means for every potential unicorn startup, over the 5 years before they go public, they should at least be able to triple their valuation every year for the first 2 years and double their valuation every year for the remaining 3 years. Every single dollar they make during this period should be reinvested back to their business. Your earnings should be expected as negative. If a VC investor sees a positive earnings on their financial statement, that is actually a big red flag because that shows this startup has a serious growth with capital optimization issue. And that leads to our reason number two. At the early stage, how to efficiently allocate a company's capital to maximize the maximum growth rate is way much more important than stacking as much profit numbers as possible on the financial statement. But also on the other hand, you also don't want to burn too much cash for just an additional 1% on your growth rate. So that maximum efficiency and the most optimized balance between the capital spending and the growth generating is the single most important thing that we're looking for as investors in order to find the next hidden gem becoming the next Tesla. Essentially, all of these high-growth companies at the early stage only had two jobs. accumulating capital. This includes both generating revenues and raising money from the investors. And the other job is to utilize those capital to grow the company as fast as they can. If a company has to burn a lot of money just to generate an average amount of growth, this company will not succeed over the long run. But on the other hand, if a company can make a lot of revenues but fail to utilize those revenues to increase their growth rate, they will also struggle over the long run. So are there any most optimized ratios between these two factors? Well, there's actually a group of investors have studied the most successful 68 public traded software companies in the tech sector, and they find out something really interesting. They find out that those successful software companies overwhelmingly have one thing in common. The total sum of their growth rate plus their profitability rate is around 40%. They call it the rule of 40. And on top of that, this rule of 40 applies to other high growth companies in the tech sector as well. So here's how the rule of 40 formula works. First, we need to know how fast this company is growing on a yearly basis. The most standard way is to use the year-over-year revenue growth rate. We can easily find this data on Seeking Alpha under the Growth tab. Then we need to know the profitability rate of this company. This profitability rate means out of all the revenues this company can generate each year, how much they keep as profits and how much they spend to grow the company. This one is a little bit tricky because there are different ways that it can measure how profitable a company is. For example, we can use EBITDA, operating income, free cash flow, or even net income. But in general, it depends on how conservative you are as an investor. If you are on the more conservative side, you should use net income margin as the profitability rate. But if you are less conservative and a little bit more aggressive investor, it's better to use EBITDA margin. Both of the numbers can be easily found on Seeking Alpha under the profitability tab. Well, personally, I prefer using the EBITDA margin over the net income margin. Alright, once we have the company's revenue growth rate and the EBITDA margin rate, we can add them together and compare the result with 40. What we're looking for here are those companies with the result at the very close to 40%. The closer the result is to 40%, the better. Let's take a look at one real example. We have three companies here, Uber, Roku, and Twilio. These are three of the most popular high-growth companies with negative earnings. So which company do you think will have the best potential to give us the best returns in the future? Let's use the rule of 40 formula to find out. These are the numbers we can get from Seeking Alpha. For Uber, the year-over-year revenue growth rate is 15.8%, and the EBITDA margin is negative 33.2%. So if we add them together, we get a negative 17.4%. For Roku, the revenue growth rate is 57.5%, which is very impressive, and the EBITDA margin is negative 1%. And for Twilio, the revenue growth rate is at 55.3%, and the EBITDA margin is negative 13.5%. If we add up these numbers for each company, we can see that actually Twilio's number is the closest to 40%. That indicates Twilio has the most optimized capital allocation efficiency and the highest probability to deliver the best return in the future. Roku's number is not bad, but not as optimized as Twilio, and Uber is the worst among three of them. The number shows Uber is actually struggling to utilize their revenues to deliver higher growth. So if you're an investor and are looking for the next best investment idea, Twilio should be your top candidate to do further research and study. Roku can be your second choice, and you should stay away from Uber, at least at the current moment. Alright, there's one important thing I want to highlight here is that although this rule of 40 formula is an extremely powerful tool to predict which early stage companies will do well when they have negative earnings, it should not be your final buy signal. In other words, this formula works more like a filter instead of a final decision maker. It can help you to filter out those good candidates to invest, but after you find your ideal targets that match with this rule of 40, you still have to do your homework. You still have to study about the company's background, dig deeper into their business models, and do some basic evaluations before you make your final investment decision. Cool, here are the key takeaways of this video. First, a company with negative earnings does not mean it is a bad company. In fact, most of the successful high-growth companies that gives investors 1,000% return, they all didn't have any positive earnings in the early stage. Because optimizing capital allocation, reinvesting back the business, and generating maximum growth is their top priority, not stacking profits on paper. So if you are looking for the next potential Amazon or Tesla that can give you a 10 to 20x return, those early stage high growth companies with negative earnings are exactly the place you should be digging into. The best way to find the best candidates is to use this rule of 40 formula. Both of the history and the statistic have shown us the most optimized allocation for an early stage company is when the growth rate plus the profitability margin rate is close to 40%. The closer the sum is to 40%, the better. This formula is an extremely powerful tool for us as investors to select those companies with the best potential future returns. However, it works more like a filter rather than a decision maker. After we use this formula to filter out the best potential candidates, we still need to do our further research, fully understand the underlying business before we decide to buy the stocks. But this Rule of 40 formula can help us tremendously narrow down our research focus on the best candidates, save our time and efforts, and most importantly, increase our potential returns over the long term. Alright, that will be the end of this video. If you are new to this channel, my name is Vic. I make videos every week to share some of my thoughts on what is going on in the financial market. And I also share some educational contents to help your investing journey just like this one. If you are interested in the world of finance and business and find my videos being valuable to you, please consider subscribing. Again, thanks so much for watching guys, and I will see you guys soon.